So let's start the meeting. My first question to you, Syed, is why the financial planning is so important to the senior citizens like us.
Yes. So whenever Dr. said, I think it's a great question. As a financial advisor, we have been doing it for almost more than 18 years. A lot of times people say the question that, okay, I'm retired. I don't really worry about financial planning at all whatsoever because what I'm going to do with it. Now, I think it's a wrong concept people have it because when you're retired, this is a golden period of your life. It's the best time of your life you have it. But when you're younger, you are in something called an accumulation phase. When you are senior citizen, you're in a decumulation phase. Decumulation means that you have earned so much, you have worked hard during your younger life, but now this money that you have so far accumulated, it will become a passive income. And you will have to use the money to pay your bills at that time, having living expenses. Now, the question at that time becomes that the money is limited and this money needs to grow. So the number one question becomes, okay, what if the market goes down? We all saw for the last 1 week what happened to NASDAQ. NASDAQ fell 15% very quickly because of the inflation fear. We're all seeing it, right? Second question is that what if I'm not there? I mean, everyone I know that who are senior citizens who are successful, they have certain assets. They want to make sure that it goes past to the next generation very easily without any probate whatsoever. So what's the best way to accomplish it? Now, when you become older, you have to focus on your health, and it's not uncommon to actually get sick or go to the hospital. But during this situation, who will take care of your health at that time? That's also very important. How long you're going to live and how long the money will last. These are the questions that needs to be resolved, but there's something that needs to be done by sitting down with your own financial advisor, with your own CPA. It cannot be completely guessing game, cannot be done. That's why financial planning is more important when you become during retirement age versus investment. Because remember, right now, investment is not that important factor. You need to just preserve your capital. What is important right now, how to do the financial plan so you can have a healthy and wealthy life. This is where we're coming into play. And that's why I think it's very important that during this time, you sit down with a fiduciary, again, a fiduciary financial advisor who can look at your overall financial plan and create a plan for you. If you already have a plan, it's a good time to revisit it. Make sure everything is up to date. And this is what we're here to talk about and educate you about the importance of financial planning. So that's why, just to reiterate, financial planning is very important during retirement age.
Okay, you told us the importance of the financial planning. And I'm pretty sure most of the members have some form of financial planning. But as you mentioned, we need to revisit so that we can incorporate one grandson who has just been born, or great grandson, or whatever. With that in mind, the next question I have is, we have a Democratic president, and he is talking about raising taxes. So can you talk a little bit about the proposed Biden tax and what we as a senior can do to navigate those tax proposals?
Yeah, so the Biden administration, as you know, you have a Republican, obviously, state, but the Biden administration recently just proposed almost a $3 trillion infrastructure bill. It's right now is the voting going on. Now, when you're a senior citizen is very important though, because what happened that if you're over the age of 72, there's something called required minimum distribution. You must start taking some money out from retirement account, right? You don't have much of an option. So if you start taking money out, that becomes part of your adjusted gross income. Now, the Biden administration recently proposed a $3 trillion infrastructure bill. Whenever, as you know, Dr. Seth, you have a big bill like this, there's a big budget deficit, all right, in the whole economy. Now, the best way to fix the budget deficit is what? Is by raising the taxes. And people who will be affected the most, who makes more than $400,000. You might be thinking, hey, I don't make 400,000. But by the way, 400,000 includes everything. Includes your rental income, includes your social security income, including your passive income like dividends and stocks and everything. Altogether, if you make this more than $400,000, your tax bracket goes up from 37% to almost close to 40%. Now you might be thinking, hey, what's the big deal? You know what, it's just a 3% jump. But hey, by the way, just to let you know, if you make more than $400,000, any income more than $400,000, you have to pay additional social security tax, which is 12%. Any income more than $400,000. Plus, we all, like April, you will be filing your taxes. You have the option to do something called itemized deduction. You can do standard deduction. If you make more than 400,000, the itemized deduction goes away. Another bill is on the table right now. There's something called dividends or long-term capital gain. So if you buy the stock and just hold it for long-term, you only pay 20% tax when you sell it, right? If you make more than $1 million, that will go away as well, according to the proposal. But it's keep changing, I understand that. But that's why it's very important to try to have your income below $400,000 if it's possible. And this is why some tax planning come into play. So it's very important to sit down with your CPA and talk about some of the tax strategies that's available to you.
That 400,000, I'm pretty sure everybody knows that it's a cumulative income, including the Social Security income, the dividends, capital gains, interest. So it's an annual gross income, right?
Exactly. It's an annual gross income altogether.
Okay, and with the doom and gloom, we have a 15th of April, which is a historic date for all of us. And what can we as a senior do to claim some deductions so that we can go below 400,000?
Yes. So ideally, we should have this conversation before December, because by December of last year, we'd have probably implemented few things. So you could have done it to save money in taxes for 2021, we're talking about, right? But I will try to incorporate something you can still do for the year 2021, and something can be done for the year 2022, because January, you can do the full plan for 22 as well. Now, a few things senior citizens are not aware of, that the Trump administration in 2018 passed some law that is still applicable for you. It is not uncommon for people who retire to still have some sort of income coming from business. Let's say you invested, like I have a physician client who invested into a dialysis unit with DaVita, is still getting from DaVita some sort of K1 as an income. So if you're a citizen where you're getting some sort of income as a business, you can write off 20% of the business income as a deduction. So before April 15, speak to your CPA if you qualify for something called QBI, Qualified Business Income Deduction. I'm hovering mouse in this one. Everyone qualifies for it if your income is below 415,000. Second one is there's no income restriction here. It's not uncommon for physician, non-physician, retired citizen to actually have some sort of real estate income, rental income, another property you're collecting rent, right? So the rental income you collect, you can write off 20% of the rent as a deduction. So speak to your CPA about QBI for rental income as well if you're getting before April 15. Now, just in case if you have bought car last year, or if you're planning to buy car this year, if you buy car more than 6,000 pounds, in Kentucky, everyone buys like this truck. I see it all the time. You guys, people buy it. So if you just in case are a big fan of this big truck, if you buy a Chevy or a GMC car more than 6,000 pounds, you can write off the full purchase price of the car as a deduction. So last year you should have done it by December, but this year, just in case for the whole family, for grandchild, if we live like the same all of our Indian community in the same big house, you want to have a bigger car, go right ahead and do so. You'll get the write off the full amount as long as it's used for business. When you file for your taxes in April, you will have to either claim a standard or itemized deduction, right? Itemized deduction, a lot of times you claim food. Let's say you go do some sort of CME work, or you actually doing some sort of event and going to a restaurant and spending money. Food deduction is usually 50% of the money you spend if you're spending money on food. Last year is the only year you can write off 100% of the money you spend in food as a deduction. So last is the only year, so make sure you speak to your CPA if food deduction you can write off the full amount or not. And again, as I mentioned, standard versus itemized. What I mean by that you have the option to go for standard deduction, which is about $24,000, or you can itemize it. What I mean by itemized, let's say, for example, your mortgage, your charity, your CME event, lump it all together and try to go over the 24,000 approximate threshold so you can write off more deduction if it's possible. And then, as I mentioned, home healthcare expenses last year, if you have did some room improvements, let's say, for example, you have fixed your basement, or you actually have, fixed your ladder a little bit, just in case to give more, physical health stability to yourself. As long as the spend of money you did more than 7% of your adjusted gross income, you can write off that home healthcare expenses as well. And lastly, charitable contribution. Last year, whatever you have contributed, make sure you can, lump it together and try to get a deduction as well. So these are few of the things before April 15. Speak to your CPA that whether you miss any of the deductions or not.
That's very important because so many times the accountant, everybody is not the same, but in general, so many times accountant would say, okay, let's take the standard deduction. And then all these smaller deductions, which add up more than 24,000 can be missed. So it is very important to put itemized deduction and the standard deduction and see where you come ahead. Is that right?
Correct. Absolutely. You just summarized what exactly I said perfectly.
And talking about the charitable giving, can you shed some light on or are you going to talk later about the CARE Act? My understanding was that under the CARES Act, you can claim $600 donation over and above the standard deduction. Is that
yes,
true?
you can. You can. The CAREX over and above 600 standard, you can do it for the CAREX that was passed basically last year. And since we're talking about charitable, contribution, I just want to talk about, like, it's very common. About 90% of all my clients who are senior citizens, they do some sort of charity. It gives them some purpose of life. So when you do a charitable contribution, very often I see you give cash or you write a check. It's a mistake though. The reason is because if you have some sort of stock account, let's say, I know a client that who have a standard brokerage account and you're buying and selling stocks. Let's say you bought this company called Apple, $100 stock goes to $120. If you want to give it to the charity, don't write a check, give the Apple shares. The beauty is going to be you bought the stock at 100, stock right now 120, you give the whole Apple, the $20 profit, you pay no taxes either. So it's called double profit you're having. You're getting the appreciation, no taxes, plus you're getting the donation as well. Number one. Number two is if you are over 72, as I mentioned, RMD kicks in, required minimum distribution kicks in, right? Which is around 4%. Don't take this money as an income and then give it to charity. What we suggest, if you are charity minded, give the money, give the donation from the retirement account directly to the charity. In this way, you never get money in your hand and it is not part of your income. The money goes directly to the charity, and then that also suffix the required minimum distribution that is required. So again, if you're charity minded, which I think is very common for everyone to give charity, don't give appreciated, don't give cash, give appreciated stock, give the money from your retirement account as a donation. And lastly, if you're really charity minded, like we have a client who wants to give a lot of money to Sankara Foundation in India. We're talking about it, like almost a few million they want to give, but he doesn't want to give it in one lump sum. You're saying this, do you have a way I can just put the money into a charity, but collect some income as well, but I want to give the money slowly to Sankara Foundation. I'm just giving an example. So we can create something called a charitable remainder trust. This is just an example. This is not the scope of today's whole presentation, but I just want to give you a taste of it, how powerful it could be. You can give, let's say, $1 million to this charitable remainder trust. We can create it for you. And you can take money as an income every year if it's needed. But eventually the money can go to the charity you choose. So again, this kind of creative thing we can do. You can contribute almost 30% of your income into the charitable remainder trust, or 50% as a cash. A lot of things can be done. So if you're charity minded, sit down with your financial advisor that if few of the things can be done or not to actually get more deduction, plus you can fulfill your charity minded as well.
Just one comment, Syed, about the giving money to charity straight from a retirement account. I thought that there was a cap. Supposing you have 200,000 coming in every year from as an RMD, I don't think you can give all 200,000 to charity. I think it is a percentage of total RMD amount. Is that right?
Yeah, so basically what it means, as I mentioned, that you can only give, not the full amount, 30% of your income, adjusted gross income. So whatever RMD you're taking, 30% of, let's say your total adjusted gross income, all the dividends and everything, max you can give is 30% of that amount as appreciated stock, or 50% cash you can give it. But the max you can do it from direct amount from the retirement account is called QCD, qualified charitable donation, is 100,000. Directly you can just give it. That's the max. So there are two caps there. One is retirement account 100,000, and also how much charity you can give from your personal, which is a percentage of your total adjusted income. You're right.
Okay. Now, going back to maybe the tax planning in the retirement planning, I do not know how much it would help our group, but some of us may be getting some earned income. So you may throw some light in what they can do, as well as more conversation on the Roth conversion.
Yeah, so as I said that, Secure Act was passed 2 years ago. According to Secure Act, even after the age of 70, you can contribute into an IRA account as long as Dr. Seth mentioned, you have an earned income. Same thing with your HSA account, health savings account, you can contribute as long as you haven't tapped into Medicare. More important thing for you is Roth conversion. What is a good time to do a Roth conversion? I think this is very powerful because once you do a Roth conversion, the money grows tax-free, the withdrawal is also tax-free. When is a good time to do it? A lot of times people say, let me just do a Roth conversion. No, you just don't go ahead and do the Roth conversion. You have to put two things in mind. Number one, your income that particular should be overall low, number one. Number two, ideally the market should be down when you do the Roth conversion. For example, I'm giving hypothetical, last few weeks, we saw NASDAQ fell 15%, right? And you have a stock, I'm giving example, Apple, you bought it at 120, stock right now $100, $20 down. Go ahead and convert that shares if you think that share will go back up. The beauty is going to be you converted this money into a Roth IRA, you transfer the shares from an IRA account to a Roth IRA. Now Apple goes back up from 100 to 150. What happened? It grows tax-free. So again, timing is important a little bit for Roth conversion. Make sure your income is a little bit low. And number two, make sure that the securities you're transferring, ideally when the market is down. And in the long run, longevity, we see that men live until the age of 85 to 90. With medicine, people are living longer. And female are living more longer, looks like. So in the long run, eventually Roth conversion does make sense because most likely you're in a lower tax bracket.
That's a lot of things to digest for our group. I'm pretty sure our group has some questions, and I would like to open up the question answer chat before going to the next session. Anybody has any question, you can either raise your hand or put it in a chat box or whatever. Okay. Arvind, go ahead.
Yes. I heard about that if your income is more than 400,000, you have to pay extra social security tax. What is that?
Yeah, so basically that's a proposal. Hopefully it's not going to pass. So basically what
okay.
happened that if your income, whatever income you collect, I'm talking about up to 133,000, you pay social security. After that, there's none, right? So the new bill is saying if your income is more than $400,000, any income more than 400,000, the additional income, they are saying pay additional social security because the social security is going to run out of money. This is one way to increase
so
the.
It has not passed yet.
It's not passed yet. Yeah, this is just a bill.
Yeah, and there is one other thing I want to tell that if your AGI is more than 250,000, there is extra 2.5% everybody pays. So people doesn't know.
Yeah, I mean, this is a perfect example that not just the 400 focus on, If your income is more than 250, the excess tax we're talking about, the AGI you spoke about, is keep going higher. So ideally, you come up with different deductions to make sure income is as low as possible, but also you enjoy your life as well.
Yes. Thank you.
Yep.
I just have one comment. Maybe Syed, you can explain or explore a little bit. You talked about the 20% QBI, qualified business income deduction. That is only for K1 for the retirees who do not have the earned income, right? Any income on K1, not on the dividends or the capital gains.
Yes, absolutely. So the first point I mentioned about the QBI, that is not going to be applicable if you just have the dividends. But QBI is fine if you have a rental income. That is fine.
Anybody else has any question, comments?
On QBI, didn't say it mention it's on K1 as well as rental income. Is that right?
Correct. If you have a business K1, you can, or 1099 income, the business per point of view, you can write off 20% of the business income as a deduction. Correct. As long as the income is below 315.
If I
Full.
have a rental property, there's no K1. So still on the rental income, can I get QBI?
Yeah, so so there's no K1, so but you're collecting a rental income, right? So most likely you will have something called Schedule E. That's what you're going to have.
Correct.
Okay. So Schedule E, as long as you have the rental income, you can write off 20%. So in Schedule E, you'll have depreciation, all the schedule, right? And on top of it, you can write off 20% of the rental income as a deduction as well. No problem.
Thank you.
The question, you said about food deduction. I didn't understand that food deduction is only related to business.
For deduction, let me just share my screen one more time.
Amarji, can you clarify your question?
Question is that in the deduction, we had a food expense deduction 100%. My question is that food expense deduction only related to business or all the expenses of food you spend?
No, it's all on the earned income.
On the earned income, you have it. So in other words, you need to have some sort of side business running in.
Okay, that's what I.
Right.
Okay, good. Thank you.
Yeah.
Okay, Sushil Bhaiya.
Thank you. I want to go back to QBI on rental income. So you take 20% off of the rental income and then the rest of it goes through expenses. Whatever is left over is what you pay taxes on.
Yeah. So QBI, ideal situation I'm talking about, you should take all the expenses out, all of it. You also should take a depreciation because depreciation is more powerful than QBI, right? You take a depreciation as well, and then you calculate the QBI, whatever money left over.
Okay.
On top of it.
I have one suggestion. All the points that you added for conversion of retirement account into Roth.
Yes.
There is one more factor that everybody should look at when they convert that, other than when the market is down and all that. Whatever bracket they are in tax bracket. So they should look at what tax bracket they are in and go to the maximum of that tax bracket if there is still some gap there. And that much amount you can convert to Roth without going into the next bracket.
I think it's a very important point. I think it's a very important point, what you mentioned.
Yes, I hope everybody understands that, but that's one factor to be considered.
Yeah, so he's mentioning like 250,000, there's a different level, 300 different level, 350 different level. So let's say your income is 200, from 200 to 250, the bracket will remain the same. So up to 50, do Roth conversion. So also that's very important too. So yes, it's not just as simple. So that's why, I'm hoping everyone has a good CPA. Sit down before you do anything.
Thank you.
Syed, on the backdoor Roth IRA, as I mentioned, we are all seniors, and most of us may not have earned income. Can we still do the 7,000 non-deductible contribution to IRA and convert that to Roth? If we are
right. So basically, ideal situation is that there are two options. So again, there's a lot of variables there. I'm just throwing ideas. So make sure you speak to your CPA before you do anything. So backdoor Roth IRA, the idea is that let's say you have no earned income. I'm just talking about. But what you want to do, you want to contribute into a retirement account, post-tax money. I'm just talking about, and then you want to convert it to a Roth IRA. There's no income restriction in it, but in order to contribute to an IRA account, you need to have some sort of income though to do it. All right. So as long as you have some sort of earned income, you can contribute. Let's say if you decide to do a post-tax IRA, fine, you can contribute a post-tax IRA, want to convert it to a Roth IRA because you max out everything. Yes, absolutely fine. But backdoor Roth IRA, at this stage may not make sense if you don't have any income. You should consider doing the existing IRA to convert it to a Roth. Backdoor may not be that applicable. Or number two, if you have, let's say, some sort of earned income coming in, very low earned income, maybe just a Roth IRA you may qualify, because I think the limit is about 170,000 income restriction. Most likely earned income is below that altogether, earned but unearned altogether below 170, you may qualify for just a direct Roth IRA. So one option could be just do the Roth IRA. Why just opening an IRA and then flip it to a Roth IRA? So that's called backdoor Roth IRA. So Roth conversion, I see people do more versus backdoor Roth IRA for senior citizens.
I did not follow that. Can you please explain that one more time?
Yeah. So basically what backdoor Roth IRA is, let's say, for example, you don't qualify to contribute into a Roth IRA because in order to contribute into a Roth IRA, your income needs to be a certain limit below 170,000. Okay. So what basically you can do, you can open up an IRA account post-tax, I'm talking about. So in a post-tax IRA account, post-tax means there's no deductions. You can just contribute money into the IRA account and contribute $7,000 over the age of 50. You can convert this money at that time to the Roth IRA. Because remember, in a Roth IRA, the income limitation is below 170. So the whole idea of a backdoor Roth IRA, you contribute into a post-tax IRA account, convert the money to a Roth IRA at that time. In a conversion, there's no income restriction.
So if I don't have any earned income, can I do $7,000 into IRA and then convert into Roth IRA backdoor way?
Yeah, so if you have so in order to contribute into an IRA account, you need to have some sort of earned income. If there's no earned income, or your spouse has no earned income, so how's that going to work? So obviously that's not going to be working for you.
Okay.
Yep.
Is there any age limit for that?
No. After Secure Act, the age limit went away. Before the year before last year, before Secure Act, after 70, you're not allowed to do it. But after 70, you can just contribute to an IRA and flip it. No problem.
Okay, that's a very, very interesting and very complex subject. And as Syed said, that we need to sit down with the fiduciary investment advisor and the CPA to take care of it so that we can minimize the taxes and get the most out of our savings. If anybody has any further question, then we can entertain or we can move to the next topic. Okay, hearing none, let's talk about, I think you mentioned some about the retirement accounts. And we also talked a little bit about the tax deductible vehicles besides retirement account. Can you share a little bit more light into that?
Yeah, very quickly, I'll mention that beside retirement account, because retirement account at this stage, conversion, I mean, as I keep saying, that's what we see all the time because earned income coming to a factor all the time. But I'm saying if you're business savvy, I see all the time my clients who are retired, they do invest into real estate a lot. So if you are interested, or if you have invested before into a real estate, try to invest into opportunity zone. For the last few years, it is very popular. In opportunity zone is very popular since 2018 because in opportunity zone, it's an area where there's a 20% poverty rate. You buy into an area, a property I'm talking about, and hold on to it for 10 years. As long as you hold on to it for 10 years, there's no capital gain tax. I think it's very powerful, number one. Number two, in stocks and mutual funds, if you have a lot of profit, you want to defer the taxes, again, you can invest into opportunity zone and defer the money in taxes if you want to. But again, I'm just talking about very simple concept. There are more into it. But again, speak to your CPA about opportunity zone for real estate if it makes sense for you. And this is obviously for the year 2022, right? Because 2021 is kind of too late. Number two, 5 to 9 contribution. Again, we're talking about for 2022. If you have grandchildren, you want to get a deduction. Kentucky, there's none, but Indiana, you can contribute funds and get 20% of that, or maximum $1,000 state tax credit for Indiana residents. So again, these are very powerful 5 to 9 contribution as well for the grandchildren. If you want to get a state tax deduction, that's powerful. Now, for 2022, if you book a lot of profit, let's say nowadays market is down right now. If you have some losing stock, you can sell some of it and do something called tax harvesting. What does tax harvesting means? If you have any stock which are actually profitable, you can book a profit as well. In this way, it's net out to a zero taxable gain for the year 2022. Plus, if you are negative for the whole year, you can claim up to $3,000 taxes losses. I'm talking about from the personal income as well, up to $3,000. But again, tax harvesting is very important. And lastly, I do not know how many people invest into real estate, but I'm just going to throw it out there. If you invest into real estate, there's someone talking about mentioning about Schedule C. I talked about for that particular person. Let's say you have a lot of rental income coming in. You did QBI plus what you did a depreciation. Still, you have a net positive rental income. How do I offset it? You speak to your CPA, something called cost segregation for real estate. So what cost segregation does for the next, so any commercial property, there's a 39-year depreciation. Residential is about 29, commercial 39. Cost segregation, what it does, it lowers the depreciation from 39 years to 5 years. So in this way, you get a bigger deduction and can write off the full rental income if you need it. But again, everyone's situation is different. I'm just giving you the taste of the ideas available out there. If you're into real estate savvy person, cost segregation is a good way to almost zero out your rental income if it's needed.
That's a very interesting ideas that you are sharing. I'm pretty sure some of us may be into the real estate renting business, so that can benefit by looking more into this strategy. And the opportunity zone you talked about, I do not know how senior citizen like me would find out which one is an opportunity zone, or how do you go by? Is there any site that you can go to, or how do you find out the opportunity zone?
Yeah, so basically nowadays, any realtor, if you just talk to, next to the property opportunity zone, big sign written there, or there's a website people use all the time. I'm not advertising the website, but I'm just giving an example called loopnet.com, LOOPNET.com, loopnet.com. You can just go there, look for properties on your under your zip code. And then that property, you can just choose income producing property, and it will say next to it opportunity zone. It is opportunity zone available. That means that area has a 20% poverty rate. Or if you just Google, show me within this area, your zip code opportunity zone is readily available. So basically it depends in your county website is there all the time. So Kentucky, I'm hoping most of you are Kentucky, Indiana, quite common to find opportunity zone.
Well, when there is a talk about money, everybody gets serious. So just on a lighter side of your presentation, do you think I can have some congressman or a senator to change the zone into an opportunity zone.
Yeah, so top 20% earner become opportunity zone. I guess.
No,
That's something.
I was just saying it on a lighter side.
Yeah, exactly.
Okay. I think he has shared so many things. Anybody has any question so far? Please speak up so we can address those questions and before moving to the next topic.
Yeah, one quick question, please. This opportunity zone investing. So if I buy a property in that opportunity zone for $100,000, just an example, hold it for 10 years and sell it for 200,000, or let's make it easy, 300,000. That 200,000 extra profit is not taxable. Is that right?
Correct. And the gain, no taxes.
Okay. Now, not an opportunity zone. If I have a house where I live right now, not an opportunity zone, and I bought it for 100, and when I sell it for 300, that 200,000 is taxable, or somebody was telling me it's not taxable if you stay there for more than 2 years or 3 years. Is that right?
Yeah, so 3 or 5 years is the primary house I'm talking about. You pay no taxes. Up to, I think, $500,000 is the cap. Up to $500,000.
Okay.
Right. But since you mentioned that, one more thing, I mean, I didn't know how much to talk about the real estate. One thing, what we could do, let's say if you have a rent, you bought a house, I'm just giving an example, not primary, another house, you bought it and you flipped it and you have some gain. One thing you can do is called Section 179. I'm talking about. It is called flipping similar property. You can do it. So you can flip it similar property as long as you use a Section 179 or Section 79 is called likewise property. You can defer the taxes too.
Thank you.
Okay.
Thank you.
Yeah.
Okay, now moving forward, what you talked about the estate planning for the seniors, but can you share some of the mistakes we may or may not be doing and how to avoid those?
Yeah, so, what we're talking about, obviously, Dr. Sheth over here, off of this whole topic, I think we're talking about the most important topic, which is the estate planning. Because we have accumulated all the assets, we want to make sure if anything happens to any one of us, the funds goes to the right person. A lot of times within family members, there are members, you don't want them gift properties, right? Sometimes it happens. So how do you ensure it? So that's why it's very important that you sit down with your estate planning attorney, update your will and trust. Unfortunately, during COVID-19, we saw the people get affected the most are senior citizens, unfortunately. And during that time, like for the last 2 years, most of our business were in estate planning. People right away calling us and say, I want to get a will done. I want to get a trust done because the urgency were there. So we always recommend by looking at it, one thing is certain in life is uncertainty, right? So that's why it's very important to get basically a will and a trust, get it updated. Now, going back to the question Dr. Sheth asked, that what are the mistakes we make when we create the will and trust? Number one mistakes I see all the time that we see clients create a will and trust. Let's say they go to an attorney, created a will. If anything happens to you, what needs to be done, and created a trust as well. But they never fund the will and trust. What I mean by funding is, like once you create a revocable trust, I'm giving an example, the house should be moved under the name of the trust. The retirement account beneficiary is supposed to be moved in the trust. Any brokerage account you have it must be moved in the trust. If you don't name it, all of it, you just created paperwork, it is just collecting dust on your closet. So what I mean by that, if anything happens to you, it is still go through the probate process. So that's why once you create a will and you create a trust, make sure you rename everything. You move everything under the name of the trust as well to avoid the probate, number one. Number two mistakes I see all the time that if anything happens to the senior citizens, we see on the will or in the trust, they say, give it to my children immediately under their name. it's one of the biggest mistakes you can make, because you want to make sure your assets are preserved, right? It goes to the next generation. And think logically. You passed away and your children inherit, let's say, $1 million. Your children will get married in their life, hopefully. So when they get married and they get into a divorce and they commingle this money with their spouse, the money become half, because in divorce in US is more than 60%. So never give money directly under the name of the child. The best way to give it is, if anything happens to you in the trust, force them, put the clause there in the will and trust that they have to create their own trust and transfer the money and keep the money separate. So in this way, a divorce happens, a lawsuit happens, the assets are completely protected. So these are the two major mistakes we see when creating will and trust. Number one, not funding it. Number two, giving directly under the name of the child.
Okay, well, that's very interesting. And even I did not realize to have my child to create a trust. I mean, that's a very eye opener.
Yeah.
Anybody has any question?
Hi, I have a question. Would you explain again this money not to be put in the child's name, but tell them who creates another trust? Is this after your death or before your death?
Yeah, so it's a very good question. So let me just mute everyone one more time, if it's okay. So basically the question is that when, can you explain one more time about the creating trust for the child? What's the best way to handle it? So it will be created after you die, not during while you're alive. But what you do in the trust that you created currently and while you're alive, you put the clause there, if anything happens to you, your child, son or daughter, will be forced to create his own trust. It will be under the name of the child, and that will be an irrevocable trust. All right, and that the child, so basically your trust will be the parent trust. Then you passed away, it will get dissolved, it will be distributed, right? But the distribution will not happen under the name of the child. It will be the new trust will be created for the name of the child, and then you transfer the money under the name of the child. So, and the child can do whatever she wants to do with the money. She wants to buy a house, she can buy it under the name of all that trust. The child wants to buy a car under the name of the trust, no problem. Everything she has in control. But if a divorce happened or lawsuit happened, that trust is irrevocable and the assets are protected.
Let me ask you one quick question on that thing. Can you hear me, Syed?
I do.
Okay. Now, in this thing, I don't remember 100% what we did in our trust. I think what we did, that after we die, our money will go to our children, and that money, when it goes to children, it will be only their money. That money will not be shared by the spouses. That's not good enough?
You hope, I mean, think logically. I mean, how are you going to force that, right? Your child, you say, money is yours, don't commingle with the money. I mean, your wife, the son's money, wife will kill her. Hey, you know what? I don't want to commingle with you. Everyone has a joint account. So as long as he knows that, hey, you know, when I got this money from my father, I'm not going to share with you whatsoever. 100%, my money will be separate, your money will be separate. You can just like do it, fine, you know, but it's not practical. The best way to do it is just put it in the trust. In this way, it's very simple. The child can explain it to the wife. Listen, this is in my father's will. I cannot do anything control. I need to open my own trust and keep it separate.
Sure, sure.
Thank you.
Sure, thank you.
Yeah.
Hey, Syed, I have one question.
That was my question, Syed, that if we put a clause in the will that if anything happens, the money is just for the child and not, so the clause will not be. So you
as long as you commingle the money with the spouse is complicated.
I see.
The best thing, don't commingle. Okay, what's the best way not to commingle? Is keep it separate. What's the best way to separate? Put it under your trust. Child will get it. Child needs to create his own trust. That's it.
I have a question. if you do that, your grandchild going to be pretty young, okay? If they get a divorce, what happens to the money?
Yeah. So basically, what happens if you do it? Mean you're talking about, or you already created a trust?
Yeah, I create trust to my grandchildren, okay? But my grandchildren are so young. If they get a divorce at the first marriage, what happens to the money?
Yeah, so keep in mind, the way we create the trust, I'm talking about, it always needs to stay in your bloodline. Any trust you create, it needs to stay in the bloodline. So what I mean by that, they get into a divorce, it doesn't matter. So the next to kin within the bloodline, the money can be distributed. But let's say the other spouse, the other parents got into another marriage, that child, that has nothing to do with this trust. It will be continuing for the grandchild. Within the bloodline, it will be keep going, keep flowing. From that grandchild to another grandchild, a same child, basically trust will be created. So it's called a generation after generation trust going on.
Hey, Syed,
Yes.
what is the difference between the revocable trust and irrevocable trust?
Yeah, so it's a very good question. So basically, revocable trust means you're going to create life right now in your life, most likely revocable. So you can change it anytime. So revocable means you can change it anytime. Irrevocable means once you create, you cannot change it whatsoever. And that's something in the next slide, we will talk about asset protection. Usually that's for asset protection or gifting purpose. We create irrevocable because you don't need the money. You want to gift it to the child immediately. So revocable, you create it, and then the whole idea is that you can change it during your lifetime if needed. Irrevocable, once you create, you cannot change whatsoever. Keep in mind one thing, you create a revocable trust when you die, that revocable trust by law becomes irrevocable. No one can change it. So that's why we recommend during the irrevocable time, put all the clauses there and it becomes irrevocable. So that's why it gives you the asset protection, divorce protection.
Question again, if it is a revocable trust and the one spouse die and still the other spouse can change the trust?
Okay, so usually what happens, you will have your own, so when you create a joint trust or separate trust, doesn't matter, really. So what basically happens, if one spouse die, her portion will be coming to the trust, right? Your portion will be coming to the trust if you die. One spouse coming in, her portion, you cannot change it, anything. Like she will have her own will, right? She will have her own thing. That portion you cannot change. You can basically take some money if you need to and use it for the benefit of the children, but in the reality, in the ideal situation, her portion of the money coming to the trust, that becomes irrevocable. You cannot do anything with it. Now, but there's some, once I mentioned that, I don't know how complicated you want me to go. There are a few things you can do into the trust, something called trust protector. Trust protector, a clause you can put it into a trust. In a trust protector, what basically does that it allows you some flexibility. For example, your wife forgot to put a clause there, like if one of the son is, let's say, doing drugs, cannot take money out, but your wife said that your son can take the money, but you just find out that one of the kids are doing something that you're not comfortable with. You want to stop it. Trust protector allows you to do it. So again, is one important clause to do it. It's have a trust protector clause that the trust becomes irrevocable. If anything happens to you, you want to control it. Trust protectors allows you to control all of this after one spouse dies.
Thank you.
Yep. I think, Dr. Seth, you need to unmute yourself. Everyone can hear? Everyone can hear me?
Yes.
Okay, I got it.
Okay. All right.
So, I mean, Syed can give us just a broader perspective into the estate planning. Everybody's situation is different, so
Exactly.
the best thing is to talk to the fiduciary advisor and estate planning attorney so that they can also guide. But the pointers that he gives, so we can use those pointers in the meeting with the estate planning attorney so that none of the finer points are missed.
I agree. Yep.
Okay, with that, let us move forward with the asset protection. You talked a little bit about it, and what are the other strategies that seniors can do to manage their funds and protect their funds?
Yeah, lawsuits are very common though. One of the things I see all the times, mistakes people make, senior citizens in financial planning, is that they don't want to care about asset protection anymore. Say, hey, I retired, who's going to sue me? But lawsuit happen. Especially if you're a physician, I had a client who was a pediatrician. They were saying that until the child becomes 18, a lawsuit may happen. So what I'm saying that a lot of times we see that physician who retire, the lawsuit came crawling back in. So everyone's situation is unique. In business, lawsuit may happen. You're driving a car and you hit someone, lawsuit is very common. It's not, we don't think about it. Life is very uncertain. Anything may happen. So there are multiple things you can be done to protect your assets. Kentucky, I'm just talking about Kentucky state. The best way to do it, the cheapest way to do it, is you create something called joint tenants in entirety. It's a state. About close to 19 states in the United States allow this kind of account. Again, it's a type of account. Not everyone has a basically called joint right of survivorship. Most of the people have this kind of account, joint right of survivorship. But the best way to do it in Kentucky is basically called joint tenants in entirety. It's a type of account. As long as one of the spouses are alive, the assets are protected. All right. Second option could be that if you have multiple properties for rental income, don't have it under your name beside the primary house. If multiple properties are there, each property should be under separate LLC. So if someone fell and create a lawsuit, only that property under that LLCs get exposed. And again, most of the money should be into 401k, IRA, annuities, 529, life insurance. They have elements of asset protection. Make sure you get some sort of umbrella policy. Ideally, we would recommend 2 million because umbrella policy for non-malpractice, non-professional lawsuit, they give you a good coverage as well. And lastly, if your assets are very big enough, more expensive, I'm talking about, let's say your net worth is more than 10 million, you want to protect your asset just in case if you get lawsuit, there's something called Nevada Asset Protection Trust, Domestic Asset Protection Trust, FLP, Family Limited Partnership. Everyone's situation is unique. Sit down with your fiduciary advisor who can give you further guidance.
Okay, there's a lot more to digest. Anybody has any question? Okay, hearing none, let us move on the.
I have one question, Dr. Syed.
Okay, so you go ahead.
Okay, we have one investment club, and we have an individual name on that one that is not in our estate. Is it that if we close or dissolve, it goes to the probate?
No, if somebody died.
If somebody die, okay. So spouse has to be, the amount will go to probate for the spouse, for my wife.
Anything basically under your name, unfortunately, will go to a small probate. Nothing you can do about this if it's not titled under the name of the trust. That's the fact. So the best thing would be if you're into investment club under individual name, you can do something called TOD designation, transfer on debt designation. You can just basically a piece of paper, the attorney can just create it for you. So TOD, what it does, you don't have to go to the court or judges or anything. You just go to the clerk and you can mention that the investment, because what happened, you cannot go to the investment club and say, hey, you know what, now I want my trust to be there. The new account needs to be done. The best thing to do a TOD, transfer on debt paperwork. This is the internal paperwork. You keep it in your document. If anything happens to both of you, you just present it to the clerk of the county, and it will avoid, the lengthy probate process. Still, probate will be there, but very quick.
Thank you.
Let me ask you one quick question, Syed.
Yes.
Now, when we created this trust, I remember the house is in my wife's name under her trust. The rest of the trust, my trust and other things, are not funded. So long time ago, somebody told me that to fund that trust, you can put attached to the trust paper $1 bill. Is that good enough or no? To avoid probate.
Everything is under the name of your wife's trust, you mentioned?
Just the house only.
And I'm assuming you're the trustee, right? I'm assuming?
I'm the trustee, that's true.
Yes, if anything happens to spouse, no probate. Problem is going to be if anything happens to both of you. So if anything happens to both of you, then what's going to happen is whoever the successor trustee will take over. So I don't see any probate here. As long as it's the name of the trust, all good.
Okay, so every account, like bank account and Fidelity and all that thing, they don't have to be put in a trust.
No. So only the house portion I'm talking about avoids the probate. The rest of it, obviously, if it's her individual name, your name, trust name is not there, it will go through the probate, right? Because remember this way. So how does the process work? Everyone must understand. You passed away, husband, wife both dies, right? Fidelity will not call you and your children and say, hey, here we go, take your money. Or your children cannot just call Fidelity and say, hey, give me my money, my parents passed away. No documents there because it is under your name, right? And even if you assign them as a beneficiary, what is the proof that they are your children? So basically what needs to be done at that time, a court order needed. So what happens that your children has to go to the court, submit the copy of the will and the trust, and the court will give a court order. That's something we have to mail to Fidelity. I'm giving an example, long process, and then they release the money. It takes about 3 months, but meanwhile, we need the money, right? Children may need the money. So the best way to do it is title it, the Fidelity I'm talking about, let's say if it's under your wife's name, it should be under your wife's trust. Already it's created the trust. So Fidelity will require beforehand all the paperwork that will be going to the court. So, and then in this way, what happens, anything happens to both of you, as long as your wife's trust basically owns it, the children supposed to be the beneficiary, the successor trustee can come in and say that, hey, it's already in the name of the trust, nothing changes, everything is going as it is.
So let me, I understand not exactly, but what you're saying. So all the accounts, right now the bank account is our joint account, her name and my name. So should that be put under a trust name?
It should be, yes.
And same thing on Fidelity, her account, my account, all those accounts should be under her trust or my trust. Is that right?
Yes, ideally in your situation, I don't know the full situation, yes, but sound like a joint trust will be a good idea. But if you already mentioned, because what happened that a long time ago, if you have created like under your wife only, maybe for asset protection, that could be maybe the reason, wife's trust. But right now, maybe a good time to sit down with the attorney and just change it to a joint trust. Because there are other asset protection vehicle available too right now. You can implement those. One trust only your wife, I think, is a mistake. I think at this time you need to have your trust. Your wife should have her own trust, and some balance should be there. A good combination there.
Sure. One quick question. I'll not take too much time. Now, an IRA account, her IRA and my IRA, both at Fidelity and both in our own name, that can be put in trust also or no?
No. So the way the process works for IRA account, you change something called beneficiary only, because IRA account needs to be under your Social Security, under your name. You do the primary beneficiary spouse, secondary beneficiary the trust, the funding. That's the way it works. Make sure not primary beneficiary trust will be completely done. The big mistake. Secondary beneficiary the trust.
Thank you. Yes.
Thanks.
Okay, now let us move forward.
I have a question.
Okay,
So
Arjun, go ahead.
I understand the meaning of revocable and now, if you have a joint account, now you are saying that the person who dies, the spouse cannot change it. But if you to start with, if you have a joint, we have a joint account. We don't have separate trusts. So what happens then?
Yeah. So basically, and it's a joint trust you mentioned.
Yeah, everything is in the trust, and it's a joint trust, right?
Yeah. So
we have a will that everything will be given to the other spouse if someone dies.
yeah. So keep in mind that joint or or separate trust, it doesn't really matter. I'm talking about what happened that if anything happens to either one of the spouse, whatever
Right.
portion under the name of the spouse portion, let's say if it's a joint account, you have a joint fidelity account, 50% owned by the spouse, right? The other spouse, and that spouse passed away. That 50% portion, there are something you must have put it into the joint trust, like your portion will be divided under the name of the children, stuff like that. That cannot be changed, your portion. Okay,
But,
so that's, yeah.
But we didn't write anything separately. The only thing it's written is that everything will be given to the other spouse.
Well, if everything given to the other spouse, if that's what you have written, which absolutely fine. But usually what happened that the way we write the trust, if anything happens to one spouse, what happened, the other spouse is the trustee usually. That's basically the way to do it. And that trustee can use the money for the benefit of himself, can take the money out, or for the benefit of children. That's the way it typically works. But what I'm saying, yeah, go ahead.
So then it will not be irrevocable, right?
No, again, your portion, I'm talking about 50%, the spouse, whatever you've written cannot be changed. So what I mean by that, the spouse has access to the money. I'm not saying doesn't have access to the money. The spouse can use the money for the benefit of child, but he cannot change anything, whatever portion he gets from your side. That's all I'm saying. Okay, let me repeat one more time. Maybe it's a little complicated. So let's say, I own 100 shares of Apple. My wife owns 100 shares of Apple, total 200 shares of Apple, but we join together. If I die, basically my wife 100 share will come to the joint trust. Am I right?
Right.
Okay, that 100 share my wife basically get. I have access to the money, absolutely. But you have your will as well, right? On top of it, on the will you mentioned that it give it to my husband, and then my child gets 50%. I cannot, as a husband, come in and say, by the way, let me just change my wife's trust. 50-50 doesn't go to my child. I have another child. I'm going to give it to 50%.
Okay, I understand.
So that's what I meant by that portion is irrevocable.
Okay.
Yeah.
So because we have done the same thing, whatever happened.
No problem.
So, thanks.
Yeah.
Okay. Moving forward, we still have a couple of strategies to discuss. So let us talk about the future of the proposed taxes by President Biden regarding the estate tax changes proposal. These are not passed, but they're proposed. So in case if they pass, how we as a senior can be proactive and work on it.
Yeah,
So,
very quickly. Yeah, thank you for the question. Very quickly, I want to mention here. So right now, there's something called income tax. There's something called death tax. In America, taxes is always there while you're alive, while you die, unfortunately. So estate taxes is due anything more than 22 million. Husband, wife both dies, your net worth is more than 22 million. Only then you have to worry about state taxes. Again, estate, E-S-T-A-T-E, state taxes. But there's a problem though. The Biden administration is very vocal about lowering it to 11 million, 5 million from husband, 5 million from wife. Even Biden doesn't change it in the year 2025, which is only about 3 years from now, that is going to go down regardless. Trump changed to 20. If nothing happens, 2025, it is expiring. So it's coming down regardless of Biden changes or not. It's going to come down if your net worth is more than 11 million. Husband, wife both dies, any money more than 11 million, 40% to 50% is state taxes due. All right. So something got to be done over here. So I just want to make sure that depending on your net worth, what's your situation, speak to your CPA and financial advisor. If your net worth is more than 11 million, something should be done because you still have some time.
Let me ask you, in this estate tax, the Roth IRA amount is also included, or is it excluded?
Everything is included. This is estate taxes.
I know, I'm talking about estate tax. So Roth amount is also included, right?
Yes, everything is included. Even life insurance benefit also included, though, unless you do something.
Yeah, so nothing is spared.
Nothing is spared.
Yes. Okay, then
So,
what are
Yeah.
supposing I wish I have that amount. Supposing by my death I have that amount. So what can I do as a estate planning strategy to avoid these taxes?
Yeah, so as long as you're below 22 million, I think we're okay as of right now. But if your net worth is more than 10 million, I'm talking about something should be done, in my opinion. Sit down with your financial advisor and talk about this. Again, for those individual more than 10 million, I'm talking about including life insurance, death, including Roth IRA, including everything. So one option could be like, someone talked about irrevocable trust. Usually we create irrevocable trust right now during your lifetime to gift it to the children. So you have the option to give 22 million if you want to, under the name of the child through irrevocable trust, and all money is out of your state, number one. Every year you can give on top of it $15,000 per child, per parent. So altogether $30,000 you can give it to your child or your grandchildren, whoever you want to, and this money is out of your state. Number three, you can buy a second to die cheap life insurance policy, third option. And because estate taxes are not due unless your net worth, unless husband, wife both dies, right? So one option could be just buy a cheap policy. It will pay for it after husband, wife both dies. Life insurance, as I mentioned, they are part of your state. There's no income tax. Everyone said tax-free. What they mean by that, income tax-free. State tax still there. So estate tax, the death benefit, one option could be you can create a life insurance trust, move the money under the name of the life insurance trust, and if anything happens, the death benefit is out of your state. And then a last option, which may not be applicable again, if you want to zero out your taxes, charity-minded, you can give all the money to the charity, and the children can take some income from the charity as well. But it is only very, very, very high net worth individual. So first four options I spoke about, these are really applicable if your net worth is more than 10 million. Sit down with your financial advisor, and depending on your situation, they can give you the advice which is applicable for you.
Is there any trust or something that you can do where, supposing more than 10 million, you can transfer to that entity, and that entity will give you some money as long as you live, and then at your death, that amount is not included in your estate? Is there some strategy like that?
Yeah, so it's a very advanced planning. I didn't include it. I didn't realize that someone can ask the question. So that means someone's net worth is huge. So if your net worth is that big, there's something called IGIT, I-G-I-T, effective grantor irrevocable trust. Yeah, you can just put the money into that trust, that it can give you the income while you're alive. And if you die, there's no income tax due. But this is very advanced. Whoever is asking, net worth must be huge. So definitely we can do that.
But you cannot do that through the charitable remainder trust, right? Or anything. Supposing I give $1 million to a charity, and then I get some money back from that as long as I'm alive, and then on my death, all the money stays with the charity.
Yeah, that is possible too. But remember, we have to look at the big picture. If we like, in order to do the charitable remainder trust or the other trust you spoke about, that where you can gifting it, you can catch some income, you die out of your state. We would like to see your net worth is close to 30-40 million to do all of this. I'm talking about someone's net worth is around 10 million. These are the things you do, the first four at least. Go the basic first and then do the advanced planning.
I have a question. Gift via irrevocable trust, you can have few beneficiary or have to be one beneficiary?
Yeah, so basically, I'm talking about gifting via an irrevocable trust is if you wanted to break it later on, you can break it. I'm talking about. But if you want to give it to two children, I'm just giving an example. The best is to just create two irrevocable trusts. The best, simple. But if you're just saying, no, I want to just create one, break it later, oh, fine.
Just to be on a lighter side of conversation, except for the last few weeks of the stock market is doing so well, multiplying the money by 30%, 20%, 40% growth, and we all are going to live 20 years. So that amount may not be out of reach.
Yes, everyone should speak to Mr. Dr. Seth. He will make you that much money.
Okay.
Right.
Okay, moving up further. Are there any recent changes in the tax laws like Secure Act? You talked about a little bit about it, but does it affect any way in the retirement account or estate planning strategy?
Yeah, it does, and I kept it at the very end because I don't know how many people get affected by it. It's a Secure Act. It means setting up for the whole community up for retirement enact. It's called Secure Act. It was passed about 2 years ago. All right. So why is it important? You know, think logically. I'm just trying to talk about in generic terminology before I get into detail. Before Secure Act, husband, wife, both dies. What happens to the money? Go to the children, right? And the children slowly can take money out throughout his whole life. That's the whole idea is. Let's say you have a son who's 20 years old, you give them $5 million. That child can slowly, 21 years old, until the child is 100 years old, slowly will take money out, the 5 million. Does it make sense? Everyone is clean on this one? Before
No.
Secure Act. Okay. So husband, wife both dies. I'm talking about what happens to the money.
Can you please repeat that, Syed? I appreciate that. Secure
Yes.
Act.
So before, I'm talking about before Secure Act. Imagine there's no Secure Act.
Okay.
Husband, wife both dies. And I'm giving a hypothetical number, 5 million. It goes to your child, right? Goes to your children. What happened at that time? This 5 million, the child slowly takes the money out every year. Because remember, from an IRA account, there's a required minimum distribution for the child when the child inherits the retirement account. Does that everyone understand this, right?
Yeah.
You all inherited IRA, your child inherited it. They have to take some money out though every year. Husband, wife both passed away. That child slowly will take money out. The child is 21 in the course of his life. Is everyone clear here?
Yeah.
What?
Go ahead. Go ahead.
Syed, what if we have two children?
Yeah, you can just give 50-50 each. So everyone will slowly take the money out.
What he's trying to say is the amount of money that has to be distributed to the children. He's talking about the IRA money that has to be distributed to the children, and the children can take some money out over a period of their life expectancy. This is before the Secure Act. And now with the Secure Act, the things are changed. Go ahead, Syed.
Yeah, so before Secure Act, everyone is clear, right? You have the full life for the child to do it. Secure Act came in here saying Secure Act, that the retirement account must be exhausted within 10 years. The child have to use the money within 10 years. That's the problem. You might be thinking, hey, what's the big deal? Hey, that child who's 21 must exhaust Roth IRA, defined benefit, pension plan, doesn't matter. Only for retirement account I'm talking about. Must exhaust, must use all the money within 10 years. You might be thinking, hey, what's the big deal? There's a big deal. You leave $5 million, I'm talking about, to the child. I'm just giving an example. I'm hovering my mouse, 5 million. They have to exhaust within 10 years. So the child has two options, $500,000 in 10 years or 5 million at the end of 10 years. The problem is there's a substantial amount of income taxes that's due in 10 years. If the IRA account is too big, it's a problem. The whole idea of Secure Act was there, the government takes the money quickly because the child have the whole life. Child is 21, the child has until 100 to take money versus the child within 10 years have to exhaust all of it. So this is a dilemma we're having. Secure Act is a new law passed 2 years ago. Sit down with your financial advisor, your CPA, and talk if your retirement account is too big.
Let me ask you one question. You mentioned the age 21. If the child is less than 21, say 19 years old, how long he can take the money out? Will it be 12 years or 10 years?
Yeah, it's a very good question. So, and that was the solution I was saying, that if the child is younger, let's say minor means below 18 in most of the state, it doesn't apply. As soon as the child basically becomes over minor, not minor anymore, the 10 years start kicking in. All right. So the child, let's say 15, slowly 5 years, start taking money out, nothing to worry about. And after the child becomes non-minors, 10-year clock starts.
So yeah, one comment. I think you mentioned about all IRA, but I think a Roth IRA is excluded from this. Is that correct?
No, Roth IRA is included, but there's no taxes because Roth IRA distribution, no taxes, right? So Roth IRA, everything is included.
So Syed, what you're saying is they can withdraw money from the Roth and don't have to worry about taxes.
Yes,
Whereas
yeah, absolutely.
the regular IRA, they will have to pay taxes.
Correct.
Okay, thank you.
But the problem is there are multiple solutions. I'll show you in the next slide, but this is a good time. Even if it's 2 million, I'm just giving you an example. It's a substantial taxes, like 2 million, like 1 million will be exhausted in 10 years, right? So it is a problem though.
Okay, so yeah, now you told me doom and gloom. Now I don't want to pay taxes. How do I do that? How do I reduce my tax burden?
Yeah, so there are multiple solutions available. Like, and whenever there's a problem, and that's why, you know, a fiduciary financial advisor comes into play, a good CPA comes into play, like you are business people, physician, there's a solution for every disease or every problem in life we have. And then there's a solution for this one as well, and a lot of creative solution. One solution, you know, someone, Dr. Sheth mentioned at the beginning of our presentation, Roth conversion. So that's why, you know, it's not a one simple thing. We can say, okay, this is the ultimate solution. One option could be you can do a Roth conversion of your money depending on your net worth, pay your taxes now. Remember, in a Roth, part of the Secure Act, but there's no taxes on distribution. So do more Roth conversion depending on your net worth. And number two, usually what happened that when we say when retirees leave the money, I'm talking about the IRA account for children. Usually that's what we say. Don't take money out. Do the RMD and use your joint account or Roth IRA for yourself because there's no taxes in a Roth IRA. Usually what we recommend. If your net worth is that big, if your retirement account is this big, one option could be change the philosophy, because most likely you are not into that high tax bracket right now, most likely. So one option could be you start using the money for yourself, the IRA account, and leave the joint account and leave the Roth IRA for the children. Well, that could be second option. Third option could be like, I think Dr. Amar, if I see it correctly, your name, you just mentioned, what if a child is a minor? One option could be, hey, if you have a grandchild, one option could be, and grandchild is 5 years old, and you want to leave some money to the grandchild, make the retirement account beneficiary to the grandchild. So what happened, the grandchild has some time now till he becomes non-minor, and from there 10 years start kicking in. So again, some math needs to be done. I don't know the exact formula for it. Everyone's situation is different. Something could be done here. Fourth option could be you can buy a life insurance policy. Again, life insurance comes into play. That can pay for it. Income tax that will be due. And then, as I mentioned, that if you have a bigger retirement account, don't pay money for charitable contribution from your own pocket cash. Give more money from QCD. which is called give more money from the retirement account as a charitable giving. That's why QCD is very popular as well. Or it could be a combination of all of it. Who knows, which one is your situation, but solutions are available. It is not one type solution. It could be, depending on your multiple factors that are involved into it. Sit down with your CPA and financial advisor who can advise you further.
Syed, can you go one more time quickly, please? What is this giving charity from your IRA account, QCD?
Yeah, QCD basically what it means that that every year you give money to the charity. And retirement account, what basically after the age of 72, there's something called required minimum distribution that is due regardless. Am I right? So
Yes.
$1 million means ballpark 4%. You have to take the money out as a distribution. So $1 million means $40,000. You have to take a distribution regardless, whatever you do, and that is part of your income. So far, clear?
Yes.
So what you could do, don't take this money as an income. What I'm saying, $40,000, if your budget is you will give it to the charity regardless, just give this money directly from the retirement account to the charity. Directly. And that is called QCD, Qualified Charitable Distribution, up to $100,000. And I think Secure Act has changed to more, to 200. Not Secure Act, CARES Act. You can just give directly money to the charity. In this way, the RMD, it is taken care of. And number two, you don't pay taxes on the money because you're not going to get money in your income. So, mistake people are taking, they're taking money out from RMD, put it under their name, and then give it to charity. Problem is that money now part of your income. You'll get a deduction, but the money is part of your income. And then you have to pay some excise taxes depending on your tax bracket. But if the money goes directly from the retirement account to the charity, is clean, RMD is done, retirement account has been used as well, and then that money is not part of your income as well. So that's called QCD.
On top of that, silly question, can you take that much amount as a charitable deduction?
Yes.
No,
No,
you don't have an income, so
there's no income. Yeah, there's no income, so there's no charitable deduction.
Correct. Thank you.
If you look at this strategy, it is still better than giving appreciated stocks, because appreciated stocks you can deduct, you can avoid the 20% capital gain tax, versus here you are avoiding your regular income tax.
Correct. So, it's RMD kicks in. This is better than giving appreciated stock, because now you pay 20% versus, this one is a regular income. It's about 30% at least.
Yeah.
Okay.
I have a question, just one question. If you have created a charitable trust yourself, and then you are funding the charitable trust from your other accounts, investment accounts, would it be just the same way? Would be beneficial the same way, rather than giving?
Yeah, it works. So if you create a charitable trust, funding it from your brokerage account, you can just fund the same charitable trust from QCD. It just goes to your charity.
Right. So it should come out the same way.
Same way, same deduction, same issue, same.
Okay. Way. Thank you.
Okay, I think we have a very.
The last question was, can you transfer this money from the QCDs, let's say from your IRA account? You cannot transfer it to your charitable account that you have with a brokerage firm. It has to go to a specific charity. Is that correct?
No. So if you have a donor fund, I'm just talking about, or if you have a charitable remainder trust, charitable lead trust, or a foundation, you can just transfer it there as long as it is not under your own individual brokerage account. It's the same philosophy.
So in other words, if you have, let's say I'm dealing with Schwab. If I have a charitable account there at Schwab, can I transfer it to the charitable account, or do I have to do it to a specific?
You don't have
Charity.
to give space charity. The whole idea of charitable account is you control it. From there, you can give it to whoever you want to. That's the beauty. That's why I think charitable account is very, very, very good, because you can do the QCD directly to the donor fund or charitable account.
Okay.
Yeah.
Thank you.
The best thing is it is not in your name, but you have a total control where the money can go.
Right.
Yeah.
Right.
Okay, looks like we have a very interesting discussion and conversation. Last but not the least, I wanted to ask Syed, the biggest challenge as all the seniors have is to live long and spend all the money. So what is your final take on that?
No, I would just say that the biggest challenge, I see is the systematic risk everyone will face, because what happened that the interest rate is very low. So there's not much of a yield there, right? So the biggest mistake or challenge we are seeing is that people, senior citizens, are investing too aggressively. Like they buy everything NVIDIA, everything Apple. Trading is there all the time. Like, social media doesn't help either, and buy and sell, people do it. Like recently I saw a client who put everything into Apple. Yeah, eventually the client probably made money, but recently the stock took a nosedive. So, and then their asset get depleted. So systematic risk, market risk is the bigger risk there, number one. Number two, I think it's an interesting challenge we're seeing it. Even if you take care of the financial planning needs, there's something called behavioral issue we're seeing it. Like a lot of senior citizens missing passion in life because they have right now 24 hours of their life not doing anything, right? What to do at that time. We see physicians or senior citizens coming back to work because there's no motivation. And that leads to depression, that leads to a lot of things. So that's why it's very important that you find some passion in life. Like, for example, Dr. Rajesh Sheth, he talks about yoga. So something like this, do it. If you're into the temple, if you're into faith, do it. Because the whole idea of financial planning to have a good life, have a happy life. So you have all the money, if you're not happy, none of this makes sense. So that's very important that your golden year have a meaningful life, and that involves in talking to a behavioral fiduciary advisor who can not only talk about financial advice, but talk about your personal development as well in this best period of your life.
Well, in summation, I thank you very much for your time and going over all the nitty-gritty about the planning, especially for the seniors group like ours. You are not only a good fiduciary advisor, but you are a good psychologist also. And so many times we become stingy, not spending money, and you made an eye-opener statement saying that instead of taking risk in investment, you just utilize your assets wisely and enjoy the life to the fullest.
Yes, thank you very much. I really appreciate it. I just put my website there and my phone number there. You can call if you have any question. And as I mentioned that we are a fiduciary advisor, we don't have a product to sell or anything. And we really appreciate as an organization, what you guys are doing is very commendable. I see all the time you're doing different activities, and thank you very much for having me.
Thank you, Syed. One question, quick question. Is it possible to get copies of these slides you presented today?
Yeah, I recorded everything. What I'm going to do as soon as, because by law I have to record it, I'm going to, save the recording and I'll email it to Dr. Sheth and he can send it to everyone to see it.
Thank you.
Great.
Wonderful.
Thank you.
Well, thank you very much.
Thank you very much. And Dr. Sheth, should I make you the host right now?
Oh, you make okay, you can make me the host, I guess. That's fine.
Sure.
Yeah.
Okay, hold on one
Okay,
second.
we are concluding our meeting and we will talk
That was
about some.
nice of you to arrange.
Thank you, Dr. Sheth, also.
Okay.
Dr.
Okay, I
Sheth,
just made you the. Yeah,
Thank
just
you,
made the
Dr.
host.
Sheth. Okay.
Thank
see
you,
you.
Rajesh.
Presentation.
Thank
Yeah, let
you.
me see all the happy faces.
We can see you.
We cannot see you. We cannot see your happy face.
Well,
Kamalaji, be careful about those birds. Don't let them fly.
No, 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 no. I watch them carefully.
Yeah,
Thank
yeah.
you.
You have to feed them also. Yeah, be careful.
Yes, yes, yes. Thank you.
Okay.
Bye-bye.
Bye-bye.
Bye-bye. Bye-bye.
Bye.